Good morning. Good morning, everyone. Welcome. Thanks so much for coming together. I hope you're all enjoying IPEM so far. And I was going to say how great it is to be in a warm climate, but it's particularly warm in here. So hopefully it will cool down a little as we progress. I'm your host for this morning. My name is Leon De Bono. I'm Assistant Director General of the BVCA. That's the British Private Equity and Venture Capital Association. And first of all, I'd just like to say thank you to IPEM for inviting us to play numerous speaking roles in the coming days. If you're not familiar with the BVCA, our core focus, along with our counterparts across Europe, is on representing the industry to ensure its economic and its social contribution are understood. And we have a big contribution. If that contribution is understood by our industry's external stakeholders, so your external stakeholders, including politicians and policymakers, then in a continuously changing and complex world, we can demonstrate just how aligned we are to governments across Europe on their aims in post-COVID recovery, jobs, talent, innovation, climate change and the path to net zero, and making Europe an attractive place to invest. And you'll hear from some of our colleagues from our fellow associations later today. And the need for all of the above, so demonstrating our economic and our social contribution, has become even more acute in the past few years. In the past few years, we've all become accustomed to a new era of adaptation, where we've had to be agile from navigating from one crisis to another, from COVID to the Russian invasion of Ukraine, its contribution to the global energy crisis, the inflationary environment, the outlook for interest rates, and more. And all of that against a backdrop of deglobalization. None of us could have predicted the events of the last 2.5 years. However, what everyone at this conference has conviction about, I'm sure, is that the strategies combined within private markets, including private equity, infrastructure, private debt, and venture capital, are well-governed, highly operational in focus, innovative, and able to respond to change. And that places us well for the future. So turning to today, our explicit theme is Europe, quite a lot to cover. And the title of the first two sessions naturally extend, in my view, to the whole day. Europe after a succession of crises, the challenges, and the opportunities ahead. We'll start off at a high level, then move through the fundamentals of investing in Europe right now, the investment case for Europe, then dive into specific countries and regions. So later this morning and early this afternoon, why France, why Italy, why the DACH region, why the UK, and so on. Along the way, we'll have 15 separate sessions and 60 speakers providing a wealth of insight and intelligence, and our thanks to them in advance. We have limited time, so if you have any suggestions or questions, please do catch up with the speakers outside. But to kick us off, I'm delighted to welcome Thomas Friedberger, CEO and co-CIO of Tikehau Capital. Thomas.
Thank you very much. Good morning. I guess we've heard enough negative things about Europe recently to all have in mind the challenges that this continent is facing. You named a couple of them: inflation, energy crisis, war on the European soil, Brexit. Please allow me to focus for those 15 minutes on the opportunities. Because at Tikehau we've been investing on the ground for 18 years in Europe, and we still feel as excited as the first day about the opportunities of investing on this continent, and even better, we are convinced that this positive trend is probably accelerating on the back of the deglobalization. So in those 15 minutes, let me just give you a couple of tips that probably will be developed further in the panels. Tip number one It might sound obvious, but Europe is a politically stable area. The European law is favorable to business. There is a strong business culture, strong education. It's a large market, 450 million people, including the UK, which is still geographically in Europe. And if you think about it, there are not that many such alternative in a global asset allocation to the US. Europe is probably the most appealing one from that point of view, and that's to be noted. Tip number 2, I would say the war in Ukraine has reinforced the European sentiment. I mean, the COVID crisis, I would say, has reinforced the European dynamic from an institutional point of view by allowing, for example, the European Commission to issue bonds, which is the first step toward fiscal union. Long is the road, okay, but that's the first step. But the war in Ukraine has reinforced the European sentiment among people. And it's not only about looking at surveys. If you look at recent elections or future elections, so the recent election in France or future election in Italy in a couple of days, you can remark that the extreme parties, far left or far right, have completely reconsidered their position vis-à-vis the European Union and vis-à-vis the euro. Today, if you look at Fratelli d'Italia, for example, or the extreme parties in France at the last European election, none of them are now advocating for a Frexit or an Itexit at all. And that's because the European sentiment is stronger among the people on this continent. Tip number 3, among the 3 large economic blocs, Europe has been probably the main loser of globalization. Why? Because for the US and China have enjoyed a deep, strong, and unified domestic market in terms of data, in terms of language, in terms of law, that has allowed companies from those regions to build very strong domestic positions to then gain market share outside of their domestic market. And that's not been the case in Europe. For example, it has been, of course, pretty intuitive, easier, for example, for a Californian company to do business in Texas, easier than for a Spanish company to do business in Germany. This is changing a little bit, partially thanks to the private equity contribution. We at Tikehau, we look at, for example, the growth equity business as selecting successful entrepreneurs that have built successful businesses regionally or nationally to bring them patient and stable capital, but also network and expertise to build European champions. And in the context of deglobalization, if businesses globally become more regional and we consider Europe as a region, we think we've managed to create a lot of economic value by doing that, and this should accelerate vis-à-vis building global businesses. Also, in the deglobalization, it's pretty obvious to us that it will be more difficult for US companies to do business in China and for Chinese companies to do business in the US. So relatively speaking, the balance of power between the US, China, and European companies should actually change in the favor of Europe. And also, if you look at the different alternatives that have been offered to voters in our democracies, that's not only in Europe, but also in all democracies in the world, Japan and the US, for example, voters have been given the choice between globalism and nationalism. And economically speaking, there is probably a third way, which is localism. And we believe a lot in the relocalization of economies. Globalization is now synonymous of vulnerability. So companies need to build resilience by investing locally. And so rebuilding local ecosystems is paramount. And Europe has a competitive advantage there because there are already different countries with strong cities there that we are addressing. By the way, we've always said that good deals have no wheels, and it will be even more true in the future probably. Operating locally, we have 8 offices in Europe with investment capabilities in those countries. being plugged in the local ecosystems to find the good transactions is definitely an advantage, and that's true in Europe. That's not necessarily true elsewhere. When you have a US base, you're probably in one city of the US, and you can operate on the whole continent. So probably, and that might sound counterintuitive, but relocalism is to an advantage of Europe. Tip number 4. Because globalization is now synonymous of vulnerability, companies will need to build resilience by investing massively in different trends to build this resilience. Energy transition, from that manner, is not only now addressing the climate issue, it's also becoming a true competitive advantage for companies all over the world. When you relocate, when you re-onshore a plant from one part of the world where manufacturing was cheap and workforce was cheap to Europe, you face additional costs. You need to do a lot of capex. You need to pay your people higher, better, and actually doing savings on your energy bills by addressing energy efficiency of buildings, energy efficiency of industrial processes, energy efficiency of fleets, truck fleets or car fleets, is definitely a competitive advantage. And so it's becoming an element of sovereignty for Europe, for those countries and companies, and a competitive advantage. Europe is a leader, world leader, in the field of energy transition, so this could be an advantage for the continent. Tip number 5, and it's linked to that, we strongly think that the current crisis marks the comeback of industrial policies in Europe. And what that is changing is that we've often not made fun, but observed that if you want to do profitable business in China, you need to follow the government. You need to understand where the government wants to go and invest in those sectors. And the recent news have highlighted that, the failed IPO of On Group, for example, or the Chinese government is sending very strong messages. If you want to make money in China, you need to follow what we want. It's probably also becoming the case in other areas of the world where industrial policies are very strong, like in the US, in Israel, in Saudi Arabia. It will probably also be the case in Europe. The government will have, and because there is no choice, I mean, we cannot continue to provide strong and undifferentiated support as the government have done during the COVID crisis, and the governments will need to make very strong choices, and following those choices will create mega trend in Europe and investment opportunities for sure. And the last tip I would give you is the weaponization of the US dollar. So the fact that the US have used the US dollar as a weapon, for example, to freeze assets from Russian citizens, even not linked to the Russian state, probably will accelerate the emergence of other currencies as alternative currencies to the US dollar. I'm not saying that the euro is the best placed currency here, because probably the renminbi will create another block. But for international asset allocators, and especially international asset allocators located in countries that have been supported by the United States one way or another, for example, military support provided by the US to Korea, to Taiwan, or to countries in the Middle East, will probably be more inclined to diversify their asset allocation because they are witnessing that not being being less friend with the US might have consequences for their assets. And so all of this can be probably wrapped up into deglobalization. Europe has suffered a lot from globalization. Deglobalization provides an opportunity. It was already, a fertile, I would say, land for investing because of this the stability of this region, and it will be even more in the future. So, hopefully that will have given you a little bit of optimism in this, ocean of depression. And so I will stop there, 5 minutes ahead of schedule.